Now the last segment of the EIA show for the year. I don't know if you can tell my voice. I am excited. It's nice to have a little bit of a break. Hopefully, again, all of this information was helpful for you to make decisions, to understand the data a bit better. I know that there's a lot. This one is very data centric, and hopefully you're learning a bit more about the energy markets. They're very fluid. They're interconnected. I love them. It's a lot of fun. You can be in a bear and bull market at the exact same times, which is always a fun opportunity where you can be buying and selling and playing different arbitrages. So again, we hope you have a great holiday. So with that being said, I thought this was a really good chart that BNEF put together. And when you look at the chart in general, you can see that OPEC plus supply fell by 404,000 barrels per day, month on month in November, in comparison with its output quota decrease of 2 million. So when you look at the actual output and the output quota, that's what we've been talking about, where they can they've been saying these numbers of we're cutting this, we're cutting that. Yes, they're saying it, but they're nowhere near the actual level already. So anything they say in name is really not driving much to the downside just because they're already producing there. So when you look at demand and you look at the supply is already reduced. So anything that they do on the front end, you have to say, okay, well, who does that actually impact? Because Nigeria, Angola, pretty much all of West Africa, parts of the Middle East are already producing well below any quota adjustments. So even if you get, say they come out in January and they're going to cut another 1 million barrels a day. Well, if they're producing at 40.1 and right now their actual output is 38.2, what has changed and who eats that change? And is anybody willing? Because UAE and Iraq have already said, we're not cutting anymore. And it would really be, and for those that remember, Saudi Arabia did a voluntary cut where only they had to reduce. So that's always a possibility. I don't know if that is likely, just given where they are in the market. I think realistically, they would much prefer to reduce OSPs. But the biggest concern for them when you look at spreads, and we're going to talk about them again, because if you remember in segment 1, we talked about some of the refining numbers, which there's no reason from a refiner's perspective to run Arab Light. You're not making any type of margin. MEH, which is Magellan East Houston, CPC, Dubai or ESPO are all going to yield way more money for the refiner than any Arab Light coming from Saudi. So based on the floating storage, based on OSPs, again, we expect to see a reduction again in Saudi pricing. OPEC plus member target versus actual production levels. You can see a positive number indicates overcutting production, and you can see just where everyone is on that overcutting production in terms of those levels. When you look at Russia, which isn't surprising, obviously coming into November 2022, Kazakhstan's going to go up. There's the demand for CP. Oh, that's the other one. CPC pricing into Europe is yielding a ton of money for a refiner versus Saudi. So you're going to see that they're bringing capacity back online. And that's something that is going to continue to be the case as you look forward. Russia isn't going to close that gap. So again, any cut is going to be meaningless when you look at Nigeria, Angola, as we've been saying, and there's not going to be too much of a shift. Nigeria reduced its official selling price for Igbo crude in January to 55 cents more than dated Brent. That's the lowest since January 2022 and compares with $1.62 in December. Forcados lowered, OSP lowered to dated 92 plus 92 cents versus $1.73. January price is also the lowest since January 2022. And when you look at January, and just to put it into context, I don't have the chart yet, but it's back to normal, slightly below normal, and that is all reflective of they're struggling to sell crude, even though it's competitive into the global market from a refining perspective. It's just there's not that that demand, and you continue to see weakness in Chinese buying from West Africa, a lot of that being because ESPO yields such a great premium. So why would you try to buy something else, which is all going to push the physical market down, because we're closing out the year with a lot of stuff on the water, a lot of stuff that it has struggled to sell, which is why we think things are going to get even more aggressive in January. Germany's pivot to piped Kazakh oil is going to be difficult. Kazakhstan has already sold most of its crude for 2023, and Russia would have to agree to use the Druzhba for shipment. So again, it's just something that was thrown out there, and we just wanted to look at. One of the things that is a point of contention is what is going to happen with China. And when you look at their quarterly oil demand, and one of the things that we've been talking about is their oil demand has been fairly stable. And Anas actually had a really good chart on Twitter where they've been building up storage. So just as things turn back on, they're going to look to normalize some of their storage because they don't want crude prices to go up. And they still have access to very much discounted crude coming from Russia. So there's going to be no push for them to try to go out and bid up the market. As we were saying before, we thought some of the views, especially, and I'm saying this and if you want to track what I've been saying this from the beginning of the year. There was an Chinese demand was overestimated. It was there was this view that they were going to have this huge capacity, and our point was, and we talk about this in the Econ show, their economic drive is a struggle, and their economy, especially their industrial centers, absorb a lot of heavy resid, of heavy disti, of distillate in general, and we just didn't see it, and that was what we thought was going to play out. And as you can see, as we progressed through the year, you kept getting things taken down. Then obviously you had zero COVID, you had an increased surge, and that just moved things a bit lower. But everyone's kind of cycling out at a similar point. But you can see OPEC is sitting there saying that that China is going to be at about 14.7. IEA is sitting there saying that it's going to be about 15. And then the EIA is saying it's going to be about 16.2. I'm more in the agreement of where we are for OPEC, just given the demand of crude, and we'll show you flows. The flows have increased, and we don't see that adjusting too much, going back to normal. What's going to change is going to be the export of product. And so as less product is exported and more is consumed internally, well, that's happening at almost exactly the time that demand is slowing because of economic reasons, as we talked about manufacturing PMI in the ASEAN nations, in India, which will again soften some of that blow without that Chinese product. So we still remain cautious, and we're still on the low end of Chinese demand, especially as we go into Q1, where they're going to have those surge in COVID cases, and we don't see that adjusting all too quickly. And here I thought this was a really good chart, and it's just taken from the BP statistical review of just what China is involved with. When you look at a far larger share of Chinese oil consumption goes into industrial raw materials such as naphtha and bitumen rather than transport fuels. And that's what we've been talking about. That's not changing. And I don't see the real estate market getting much better. I don't see construction getting much better. I don't see infrastructure getting much better versus where we are. So what is really going to be the driver of Chinese demand? And gasoline, there's another chart where we weigh it, and its gasoline has already been higher than last year. You've already seen some of these recoveries. The biggest one is going to be industrial, and that's going to be the big important pivot of, well, how strong or how well does this go? So just looking at Glencore, you continue to see this new crude coming out in Europe from obviously Johan as well as CPC, so that's going to help. But then when you look at Saudi crude, and again, this is going back to what we talked about in segment one, well, going into Singapore, Arab Light is only giving you 49, ESPO is giving you 24.42, Dubai 904. So from a Chinese perspective, it's like, well, ESPO I'm not putting in this price cap. So I'm going to go out and buy ESPO. I'll go out and buy Urals because it's going to yield me more. And the heavier crude is going to give me really what we need given to some of the different backdrops if there is a big increase in demand. So it's not going to absorb the same level of physical capacity that I think the market is expecting, especially as OECD countries continue to slow. We're heading into a fairly sizable recession that we're already in, going to get worse next year. And it's going to make it difficult to see that pop, especially because China is such an important exporting nation, and exporting nations import intermediary goods as well as raw materials. And if they don't have that balance, we don't expect much of any type of recovery in local consumption. So again, it's going to be a very muted recovery. We do think Q2 gets better. And so Q1 is going to be tough. Q2 is going to surprise to the upside. That's going to get everyone excited. Prices are going to rally in Q2. And I think that's going to result in a much slower Q3 and then a problematic Q4 in terms of if I had to map out where 2023 is going into next year. And China's weak oil demand in 22 has been as much about the real estate bust hitting road building as COVID zero. And I think that's a huge piece, because when you look at asphalt, when you look at kerosene, but diesel's already elevated, fuel oil, naphtha, LPG. So gasoline, kerosene, and asphalt. I mean, even if things go fully back to normal, how much are people really going to fly, which is, again, the kerosene side? Asphalt, how much, how many roads and bridges can you build to ghost cities based on the fact that nobody's there and you've already built the road? Nobody's using it, so it's not really destroying itself. So again, it's going to be a problem when you look at, as COVID zero restrictions go away or get severely reduced. I mean, how excited are people about the real estate sector in China, or how excited are people really about additional infrastructure spending? So, and that we've talked about this at nauseum on segment 5 of the Econ Show, just how slow demand is and has been. So now when you look at Middle East crude in floating storage, you can see that we're still very elevated. There usually is a bit of a bounce this time of year, and then it continues to the downside. But you're just seeing the disconnect and why we expect to see additional OSP cuts, because they're not moving volume as they should heading into next year, which they're going to want to clear, while the U.S. continues to export a significant amount, because we are competitive and we help the refiner make money, making our crude the preferential treatment versus what's coming from the Middle East. And then once you factor in all the different pieces, the cost coming from West Africa, we continue to move into the European markets. And that's why when you look at Brent has gotten stronger, and Dubai is gotten stronger as well. But there's the discount. What is the discount? And you're gonna have to see that widen if we're going to see additional product move in. Now, Dubai is competitive into some areas, but KSA or the Kingdom of Saudi Arabia, Saudi Aramco is still not competitive. So even as Dubai gets more competitive, it still is keeping Saudi crude on the sidelines, which was why they're going to have to make some sort of bigger adjustment. Crude oil on the water had a nice big drop. We're right back to where we were in 2021. Again, we expect to close out around this point. And the reason why is because you had a huge shift in crude oil in transit. So there was a huge makeup number. A lot of this is just because it went into floating storage. And then when you look at the floating storage side, floating storage came down and you can see the size difference in terms of the movements, because even as floating storage comes down, you have crude falling out of transit. It's now recognized as floating storage, but you had some of that floating storage go on land. So there is some additional out there. There's some of that disconnect between floating storage, because there is some crude that is actually in floating storage but hasn't been recognized by Vortexa. So Vortexa designates floating storage is a ship that it hasn't moved in 7 days. So if it's only been sitting for 5 days, it's not in transit anymore, but it's not in floating storage yet. So we do expect to close right at the 2021 levels for floating storage, but we don't see a big increase in transit yet as some of those crudes slip away. Asian floating storage coming down a bit. Again, we do expect a little bit more of an increase, but it's going to be right around this average. We thought it was going to be closer to 2021 levels. It's not. A lot of that is because of the lifting of COVID restrictions. You've had a big increase of product moving from floating storage to onshore storage, which is why I think Anas's picture on just how big Asian Chinese floating onshore storage has gotten is going to be very important when you look at how much crude are they going to buy. Are they going to try to draw down some of the capacity that's onshore? And that's going to be a big movement as we go into Q1. And then the super tankers heading to China have slowed. We're just below where we were last year, but we're still well above where we've been going back to 2016 because there's still a lot of crude heading into China. There's still a lot of that product. So when you look and say, oh, well, China is going to continue to be a big buyer, it's like, well, they have been, and yet differentials are still weakening with China very active. So I think that speaks to a broader issue, and that's not something China is going to be able to carry as we go into what is a steeper slowdown next year. So then when you look at refining activity, it went from 65.9 to 66.2. We do think Shandong can get to about 69 at this point. It's actually right now closer to about 68. But the issue is the state-owned guys are still at about 75. They're not where China wants them to be, which is closer to about 85%. And a lot of that is because onshore demand just isn't very good. And there's a lot of product in storage. There's a lot of crude in storage. So there's going to have to move some of that through, or they're going to have to increase export quotas for product in Q1, try to balance some of that, open up some storage for refined products, and then convert that crude into something that can be stored. West Africa crude floating storage, fairly stable. We expect it to close out, a little bit higher, but not too much at this point. We've had a sizable reduction in production estimates or I should say loading schedules for February, and it's because there's some concern about more floating storage in Jan, so they're going to look to try to clear some of that as we get into February. And that also speaks to if there is a cut in Jan, based on what has been scheduled by Angola and Nigeria, they're going to be more than compliant with any decision that comes out in the January meeting. So when we look at the U.S. Gasoline exports fell 316,000 barrels, still well above the 5-year. It's going to stay there. Distillate, same thing, still going to stay above the 5-year. Propane, propylene, still elevated, going to stay strong. U.S. exports still holding at that 4.3 number. Again, it's all about timing. When is it being released? But it's really, we've been saying 3.8, 3.9. It's probably butting up against the boilerplate level that is physically possible of about 4.1, just given the amount of crude that is moving into the international markets, i.e. Europe. Finished motor gasoline, we just said it was gonna stay well above the 5-year average. It was gonna stay at the top of the cloud. But you can see, seasonally speaking, we get a drop, and it's just gonna follow the seasonal norm, just stay at the very high end of that norm and well above the 5-year average. Same can be said for distillate, staying at the very high level. You can see it dropped a little early but a lot of this is timing. And just given Europe is very open for the export of product. And there's actually a number that we'll use in a second to show just the level of product that's flowing into the market. And let me see if so here, the U.S. is sending the equivalent of 1 cargo every day to Europe so far this month. That's the fastest rate since June 2018 and quadruples the November rate. December flows so far total 310,000 barrels a day, up from 78,000 barrels a day in November. Strong flows reflect European efforts to stock up before EU bans of Russian crude, which is why you're going to see a massive amount of U.S. product flowing into the European nation, which is why we're going to continue to see this this number, the distillate fuel export, continuing to be very high, will likely set new seasonally adjusted records as we get into January and close out the year very strong. U.S. exports, something very similar. Propane, propylene, again, flatlining up here, but you can still see seasonally adjusted, very much at the highs. That will continue. Then when you look at what happened in Fujairah, December 19, total oil product stockpiles came in at 19.296 million barrels, which was a drop of just over 5 million. And the stock movement saw a drop across all three. Light distillate fell 1.412 million. The East of Suez gasoline complex was range-bound amid firm gasoline demand in the Philippines ahead of year-end festivities and the likelihood of South Korea and Japanese exports increasing on poor domestic winter demand. While loosening COVID-19 restrictions had been expected to prompt higher driving activity, a spurt in cases could restrict mobility in the short term, leaving spare gasoline volumes to export. Again, all in line with our view. So we do expect to see builds continue in light distillate. There, you did get additional movements because remember, it's not just Chinese Lunar New Year, it's Asian Lunar New Year. So everybody within the region celebrates it. So we will get some festivities that's going to absorb some product. But we're already at the higher end, and we do see some builds in the near term as things slow down for Christmas, New Year's, pick back up for the Lunar New Year, and then drop off again as we head into Feb. Middle distillate fell 1.33 million. Then when you look backwardation, the benchmark East of Suez gas oil market continued to narrow while the pace of spot tender activity improved. Spot tender activity for January loading cargoes picked up from the beginning of the week. Meanwhile, medium and high sulfur gas oil grades in Asia are under pressure. And that's something we see continuing because a lot of that product also goes into the industrial side. And that's where we see a lot of issues on the industrial piece, as we talked about in the Econ show, which is going to put more product in storage, but it's going to be what kind of grade. So we do see middle distillate here going back to 3 million, which is still very much on the low end, but a lot of it is not going to be ultra low or very low sulfur, which is going to adjust the pricing, so to say. Heavy resid dropped 2.319 million. Spot trading activity at the bunkering hub of Singapore and Fujairah were mixed. Demand was said to be robust in the city-state, while buying interest was reported to be less than average in Fujairah. And again, it's going to be a matter of some of those flows. We do see that trending back to over 11 million. When you look at Brent time spreads, contango worsened. We expect it to bounce a little bit, but again, stay below about 15 cents just because of the issues that we've seen. But we did get some price increases. Glencore raised its bid for Severdrup. BP offers Fortes. But when you look at Glencore, the Glencore adjustment went from $5 below dated Brent to $4.50 below dated Brent. So you're still in this. It's just you're not going to have as steep of a contango. But it's still going to be a struggle to move some of these cargoes. And then when you look at the numbers, as we talked about in Nigeria, Angola, they're well below where they were in January, which means that they do expect to see some carryover. They expect some of the cargoes to slip from January into February, and they're trying to manage their floating storage. So they're like, all right, well, why are we going to increase in production and exports? Let's just take what slips from January into February and use that to try to clear some of the glut and get some of that pricing. European storage, very normal. We don't see that adjusting. If anything, we see it going a little bit higher. When you look at their product builds, small draw in gasoline of 6, small build in gas oil of 33. We're above where we were in 2021 and 2013, but you can still see, historically speaking, Europe is still on the low end on the gas oil front. Gasoline, though, on the other side is the complete opposite and is at the highest end and is challenging 2020 for the worst year ever for gasoline inventory, which is why we still expect to see some of those flows coming from Europe and heading into the East Coast. Fuel oil, as we've been saying, is going to be fairly stable. It's going to be a matter of can they recycle it in Europe, recrack it, use it. What is the margin? What is the flow going into the Asian markets where they can consume it? Singapore, as we've been saying, is going to kind of hang here. It came in just a small drop of 100,000 barrels. Light distillate, small increase. Middle distillate, small decrease. Resid, small decrease. But we expect it to close right around this point as we head into year end. And now this is a problem just because a lot of this product should have already started to move for the holiday season. So I think you're starting to see some of that slowdown. Some of that demand has been met, especially from Fujairah. Some of it was already priced to move. So we do see some smaller increases in storage. Nothing sizable, but we do expect to see some of that storage coming through. Light distillate still staying very much at the high end. Seasonally speaking, it's right at the all-time highs. We expect light distillate to stay there and really close out, setting a new seasonally adjusted record. It's obviously not the record for 2022, which happened in the middle of July, but we do expect to see light distillate close at the highs. Middle distillate, we expect the opposite, to close at the lows. And again, it's just that flip between where is light distillate, where is middle distillate. Then when you look at resid, as we've been saying, resid is just going to close flat. We don't see too much. I should say flat versus the 15-year average. We don't see too much adjustment here. North Sea, again, fairly flat. If anything, it should creep a bit higher just as the phase 2 turns on, but it's not going to be too much one way or the other. You can see that there have been some years where you get a bit of a spike. Realistically, if it gets to the 6-year average, that's fine. We don't see too much movement one way or the other. Where Europe, big spike, big drop, which is, again, that's going to be recorded in European storage, which is why we said things should be fairly fixed at this point as we close out the year. So that's what we have for you today. Hopefully you had a joyful, prosperous 2022, and we look forward to seeing you in the new year. So happy holidays. Happy Hanukkah, Merry Christmas, and Happy New Year. So we'll see you in the first week of 2023. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.